Hello, my name is Jawad Ahmed Fareed, and in our session today, I will be your guide on linking Monte Carlo simulators with financial models. This is something that we've spoken about earlier in our courses on both simulation as well as financial modeling. But in today's session, we want to take a deeper look at this exercise. So the first question you should ask yourself before you attempt to do this is, what is it that you expect the model to deliver on? Do you expect to see prices? Do you expect to see projected P&L or profitability? Uh, what are the answers that you want the model to generate? And I think to begin with, let's start off with a simple financial variable x. This x could represent, a wide range of financial phenomena. So, for example, it could represent the price of fuel. It could represent the impact of these prices on fuel expenses for an airline. It could represent the impact of both on P&L. It could represent the value of the same fuel inventory on your financial statements. It could represent the behavior of any financial security or an index, right? Um, the process might change slightly, but the high level themes and the philosophy that we're going to use will remain the same. So now, what do we expect this financial variable to do? This financial variable is going to move up and down. Prices will change. They will behave randomly, sometimes unexpectedly. And when this happens, there is going to be some kind of an economic impact. This economic impact is the primary driver behind our analysis. So if the question we seek is what is the relationship of changes in fuel prices on profitability, fuel prices go up, fuel prices drive fuel expenses upwards, fuel expenses drive ticket prices upward, ticket prices go out and have an impact on both passenger and travel demand. That's economic impact, that's driver. And the idea is, if the answer we seek is impact of fuel prices on P&L and profitability, the process starts with simulating the change in the price of fuel, simulating the impact on expenses, and then linking it all the way back to generating a range of expected results. And these expected results go out and give us a distribution of returns, a range of values that we can then use for our analysis, for more deeper and more interesting analysis. Now, the next question that comes up once you've done this is, how do we make this process work? And to answer this question, I think we have to take a step back and take a look at, if you were tasked, if you were asked to model a financial security, where would you start? How would you start? What would that process look like? What would that process involve? So Taleb calls this the generator function. He says, if there's if there's one thing they should spend time on, it should be on understanding how prices behave. Because if you have no intuition around how prices behave, you cannot hope to model the underlying behavior. And the reason why he says this is very simple. The reason is, prices are difficult. They go up, come down, and then stay down. Sometimes they are range bound, so they go up and down, but they stay within a specific range. Sometimes when you look through trends, you can actually see them going upward straight through. Sometimes they come all the way down. The challenge is, whatever function you create, whatever function you try and model, should be able to simulate all four scenarios that you see in front of you. So if prices are range bound and flat, you should be able to simulate that. If there is a trend, even though it's not obvious, even though it's dependent on one specific range, you should be able to simulate that. So the challenge then becomes that your model, your generator function, is supposed to handle a wide range of behaviors. And I think what we have to worry about is that, how do you build something that handles prices being flat, going upward, going downwards, and falling off the cliff at the same time? What is the range, possible parameters that you could use to build this generator function? So the first hint that we see is that there is a clear direction at a simpler linear level, and we call this direction drift. That's the first parameter. Let's take a closer look at drift as well as its relationship to financial prices. So if you start off initially with a grid, and let's say this grid represents change in financial prices, If your model only had drift, you'd stop at a straight line, one direction. It might be flat, upward sloping, downward sloping, but it'll be one directional and it'll certainly be linear. But is this how prices behave? If you were to look at the chart of financial prices anywhere else in the world for any other security or commodity, you will actually see that while for shorter period of times it's possible that a trend may exist, but prices move all about. They go up, they come down. If you look at the range of movement also, sometimes, some days it's just a bit, sometimes it's actually quite large. So it's clear that drift is not going to cut it. There's too much variability in prices for them to be modeled by a simple linear relationship that covers direction. We need something much more powerful that should be able to capture the random element, this random force that impacts the overall trend in prices. So the question is, where do you start? It's not just a question of randomness. Prices can go up and down, and while you can model a part of that through a trend, sometimes the trend changes. So in reality, what you really want is a structure that allows you to not just capture direction or trend, but also allows you to capture a change in trend. The first parameter is clear, right? The first parameter is that we have direction, which we model with drift. It's the second one that we have a challenge with. This noise that's there in prices. How do we model this? So for the time being, let's just put this down. Let's say we have two parameters, one for modeling trend and direction, and we call that drift. We have a second parameter that models noise, that models the change in prices that we cannot capture through a linear or straightforward relationship. And while the first one is clearly static, or at least will suffice to be static, the second one is not. The second one is a lot more random and chaotic than we anticipate or expect it to be. So before you move forward, I want you to think about how would you model drift and how would you model noise. Also think about, are there any other basic securities that allow you to model only drift? You're also likely to see another term whenever you see drift, and that term is diffusion. For the time being, I just want you to remember that the impact of drift and diffusion is not the same, it's not approximate. So let's go back to our second question. Our second question says that, is there a security out there that we can use to just model drift or to build a better model for understanding drift? And the answer is, think about a bond. If you have a bond and you try and model the price of that bond, how would you start? Where would you start with? So the first step is obviously the amount of principal that's owed, right? So if you've gone out and issued a bond for $100, the principal amount that has been borrowed by that bond, through that bond, using that bond, is the amount invested, and that amount is denoted by the letter B0. So B0 basically says, I've put in $100, and my question is that how would this investment, how would this amount grow? It's going to grow at a rate R over a period of time T. And my next question is, if that's the case, then is there a model that allows me to answer the question of what would be the value of BT at any given point in time? And the answer is yes. It's B0 into 1 plus R raised to the power T, the old compounding formula that we all studied in high school. And what if you want to continuously compound it? If that's the case, then the formula changes to B0 into E raised to the power RT, where E is the exponential function. Continuous compounding implies that interest is being earned, is being accrued at infinitely small intervals all the way up to maturity. And obviously, because of the continuous nature, you go from 1 plus RT into B0 into E raised to the power RT. Now the question becomes, how does the price of the bond change from one time step to the next? And if you're doing continuous compounding, from one infinitely small time step to the next. We represent this by delta BT representing the change in the price of the bond at any given point in time. And the change that we calculate is simply principal B0 into the rate R into dt, the time step. Now, if you added all of these changes and looked at total change, so change for over the next 3 months or 6 months or a year, that gives you the total value of the bond at any given point in time. That change is given by b naught into e raised to the power rt. That's our old exponential function. And what that essentially says is that if you want to look at the total return on the bond, on a simple bond, that's earning interest on a continuously compounded basis, you take the original amount invested, the principal, multiply it with e raised to the power rt. And what rt is effectively saying is we will earn interest at the rate r for the duration of time t. And that total interest, that total return, that total profit represents the incremental change in the value of the bond between time 0 and time t. Total change, not marginal change, not change between one small infinite time step, but total change. So what then this says is that if you're looking at static return, if you're looking at return given by drift, then the simple model, the best model, is the exponential model that we've used, and you can go ahead and apply it to any financial security, not just to bonds. Remember, you're not modeling noise, you're not modeling diffusion. All you're modeling at this specific point in time is drift. And the model for drift that we have in front of us, as it applies to any security, whether it's Apple or Microsoft or Dell or oil or gold, is bt equals b naught into e raised to the power rt, the exponential function, the drift. There are some changes when you move from equities to currencies, from currencies to commodities, and we'll touch upon them a little later. But for now, let's be very, very clear that as far as drift is concerned, the simple model, the easy model that we want to work with for total return is e raised to the power rt, and that's the model that we will use as we move forward with our next step. So our next step is, let's start off with a simple stock, a stock that does not pay a dividend, a stock that's growing using drift as a primary indicator of return, and we call the change in price of the stock as delta S, and delta S using the same model. Remember the bond model, b naught r dt is given by s naught u or mu dt, and st, the total value, the total change in value, is given by the same bond model where we used b naught into e raised to the power rt is given by s naught into e, the exponential function, into mu into t. So the question is, what is mu? In this model, what does mu represent? If you remember the Black Scholes world, in the Black Scholes world we use the risk neutral assumption, which basically means that all investors earn the risk-free rate. In the Black Scholes world, mu is given by r minus half sigma square, and all I'm going to do is simply transpose that mu from that side of the presentation to in a model here. When I replace mu with r minus half sigma square, I end up with st equals s naught into exponential function e raised to the power r minus half sigma square into time t. And this is my basic initial simple model for drift. But what about noise? How do we model noise? What does our next step involve? So noise is, we know it's random, one. We know that it has to scale, it jumps up and down, so the size and magnitude of movement itself is also not constant, which means it's proportionate to something. So three questions: how do you model randomness, how do we scale it, and what is it proportionate to? The best proxy we have for noise is standard deviation, but standard deviation needs to have two additional adjustments. One is it's proportionate to time. Prices move less in one day and they move more in a month or a year. Second element is a bit more tricky, and this element is what we call ZT, a normally distributed random variable, and we use this to bring in the randomness that we wanted noise to represent. So two pieces. Noise is represented by two components. The first component is standard deviation scaled for time, more time, more volatility, less time, less volatility, and ZT, a normally distributed random variable that comes in, plugs in the element that we need to use for randomness. And then if you were to just build a separate simple model for noise using the same format and template that we seen earlier, we actually end up with, we say, in our model for stock price that we are building, the component or the element for noise is represented by E exponential raised to the power sigma under root t into zt, the normally distributed random variable. So here's a quick summary. Our model has two pieces: drift, which is the trend or the primary signal, and we model it using one approach that we discussed earlier. Our second component is noise, and we model it by looking at standard deviation. So as far as drift is concerned, we start off by saying that mu, the expected return, our best guess case for mu is r minus half sigma square. If we integrate it and look at the impact of mu over prices, that's given by e raised to the power r minus half sigma square into t. So the change in price on account of simple return, periodic return, total holding period return, static return, drift related, trend related return is given by st equals r e raised to the power r minus half sigma square t. And the same component for noise is given by sigma into under root t into zt, where zt is given by where zt is a normally distributed standard normal variable. And when you bring this together, you end up with e raised to the power sigma under root t into zt. So change in the value of s because of the drift related component is sigma is s naught into mu into dt. Same concept, b naught into r into dt, plus a component for drift plus a component for diffusion given by s naught into sigma into dz. And when you combine this together, when you put these two pieces together, you actually end up with a combined model, which looks a little tricky, but it's not that difficult. Value of st, the price of st, is given by s naught into e into r minus half sigma square into t plus sigma under root t zt. That's the simulation model. That's the model you want to plug in into your Excel spreadsheet. That's your primary simulator for simulating stock prices. Now if you want to go from stock prices to equities, from equities to currencies, there are going to be slight changes. So now let's take a look at building the Excel model. So we've covered a fair bit of theoretical background. How would you put an Excel model together that does this for you? Luckily for us, I think Excel comes with inbuilt random function, and it's the same random function that we'll use, but there is a small challenge. The challenge is that Excel's inbuilt random function, it generates a random number, but that random number is uniformly distributed. It's not normally distributed. And what we want for our purposes, if you remember zt is normally distributed. So our first challenge, our first step is to figure out how to take this uniformly distributed random number, which Excel generates for us using the rand function, and translate that and convert it into a normally distributed random number. When you say a number is uniformly distributed, what you really mean is that all points between those numbers, between the numbers in the range, have equal probability. So in Excel's case, when we use the UDD or the uniform distribution, we basically say is that all numbers between 0 and 1 have the same probability. How do we translate this into a normally distributed variable? I think we start off with saying that we don't need any number. We actually need what we call a standard normal distribution, which basically means that distribution where the mean of the distribution is 0 and the standard deviation is 1. So we take this standard normal distribution and use it to generate our ZTs. We then multiply our ZTs with sigma under root t to bring together a model for noise. We take this model for noise and add it to our model for signal and drift. And then the combined model gives us the simulated values. This combined model that includes noise, signal and drift, this model basically gives us a distribution of simulated values that we can then plug in into our financial model. So you take these financial values, these simulated values, plug them into your financial model, and you're done. And the idea here is that whatever you're trying to simulate, whether it's fuel prices, gold prices, financial portfolio security prices, The Excel model generates the prices for you. You plug them into your financial model, and that should complete a large part of your exercise. What's the first step? The first step is generate the random number. Second step is convert that into a normally distributed random number. Third step is use this ZT, multiply it with your sigma under root t. Fourth step is add it to your signal drift model. And the fifth step is use the simulated values, plug them into your financial model, and that'll take care of a large part of your work. So this is Jawad Ahmed Fareed signing off for financetrainingcourse.com. Thank you very much for taking out the time to attend our session. We hope you've enjoyed it,